You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. In this episode, we're talking about IOLTA accounting mistakes. IOLTA stands for Interest on Lawyers' Trust Accounts, a type of bank account that attorneys hold client funds in until they're meant to be dispersed. These aren't the headline-grabbing mistakes that make the national news. No, these are just the bookkeeping-related ones. If you're running a law firm, be it you are the lead attorney or a managing partner, you already know IOLTA compliance isn't optional, as you must attest to it every year. It's not a suggestion, because any attorney's license hinges on following the rules of conduct which governs the treatment of IOLTAs. Most problems I've seen don't come from bad intent. They're from small misunderstandings that slowly compound over time. All of the attorneys I've met are incredibly smart and capable people, but it makes sense they aren't all accountants because a lawyer's life can be difficult enough as is without having to wear the hat of an entirely different industry. So today we're walking through 5 of the most common IOLTA mistakes I've seen in California firms and how to avoid them before they turn into something serious. On to the first common issue, not performing a 3-way IOLTA reconciliation monthly. Let's start with one that everyone thinks they're doing right. Plenty of firms reconcile their IOLTA bank statement each month, your typical one-way reconciliation in which they check the balance against your QuickBooks balance and call it a day. But that's only one piece of the process. A true 3-way reconciliation compares the IOLTA bank balance, the total of all individual client ledgers, and the IOLTA liability accounts inside your book. All 3 need to match exactly to the penny every month. If they don't, it means someone's money is off somewhere, be it yours, the client's, or a vendor. Maybe a transfer posted late, maybe a check cleared under the wrong matter, but until you trace it, you're technically out of compliance. Under California Rules of Conduct 1.15, this isn't just good practice, it's a requirement. Most bookkeepers and accountants wouldn't be familiar with these standards naturally. Training and continuing education in all things IOLTA are a must for anyone handling your firm's books. The second mistake we've seen many times in the past is using the IOLTA to pay for case costs before a matter settles. This one's rather common and deceptively innocent. A firm covers filing fees, expert costs, or transcripts out of the IOLTA, planning to reimburse once the settlement funds clear. The problem is, unless those funds were specifically deposited for that client's expense and the ledger reflects it, you're spending one client's money for another client's work. That's the definition of commingling, even if there were no ill intentions. The rule is simple. Client money stays in IOLTA until earned, invoiced, and properly transferred. Firm money, including advance costs, comes out of your operating accounts such as the business checking account or more often, one of the business's credit cards. If you're fronting costs, let the business pay for it first and reimburse once settlement funds arrive. It's cleaner, defensible, and avoids the gray zone of, we meant to pay it back. The issue at number 3 is not consulting your bank when a deposit is too large for an IOLTA. IOLTA accounts exist for funds that are nominal in amount or held short term. The interest from those pooled funds goes to the State Bar Foundation. But when you have a single deposit that's very large or held for a long period, say a major settlement or a real estate escrow, that interest might belong to the client. In California, you're expected to consult with your bank when that happens. If the funds are substantial enough to generate meaningful interest, they may need to be placed in a separate interest-bearing trust account for the benefit of that client. If you leave it in the pool IOLTA, you could be misdirecting funds intended for that client. If you put it in the operating account, well, that's worse. It's an easy fix though. When in doubt, call the trust department at your bank and confirm where the funds belong. That one phone call protects both you and your firm. The fourth mistake we've seen quite a few times is misunderstanding flat fees and the client's right to choose. Here's where things get nuanced and where some firms stumble. In California, for instance, if a client pays a flat fee or retainer in advance, the default rule is simple. It belongs in the IOLTA until it's earned. There's one exception, and it's written into Rule 1.15b3. If you want to treat the flat fee as earned upon receipt and deposit it directly into your operating account, you can, but only if you disclose in writing that, number 1, the client has a right to require the flat fee be deposited into trust until earned, and 2, the client is entitled to a refund of any unearned portion. And if the flat fee is more than $1,000, the client has to sign that agreement. Now, if the client chooses to have their flat fee deposited in trust, you must deposit into the IOLTA first. Once you actually earn that fee, meaning you perform the work or reach the point of your agreement that defines it as earned, you can immediately transfer it to your operating account. The sequence matters. Deposit to trust first because that's what the client required, and then move it when it's earned. Sometimes it's not about the agreement or contract, which were already satisfactory. It's sometimes a clerical or administrative issue where the funds are deposited into the wrong account. When you attest to your IOLTA compliance, you're responsible for your entire firm's actions revolving around your trust account. Be sure that every member of your staff understands the rules and knows the right way to handle the client's funds. Having written procedures, training materials, and posted reminders on bulletin boards or walls are integral in maintaining compliance. Remember, it's not about where you want the money, it's about honoring the client's right to choose where it is deposited. Lastly, at number 5 is assuming an inactive IOLTA doesn't need monitoring. Here's the quiet one, the one that surprises firms during audits. An IOLTA with no activity for months feels safe, but quiet doesn't mean clean. You might still have small interest postings, old client retainers that were probably earned, bank fees hitting the account, or what we see most of, check fraud. If the account drifts by even a few dollars, it's technically out of balance, and a bar auditor will catch it in minutes during a routine investigation. If there are funds in your IOLTA that you already earned, then it's possible you didn't remove it in a reasonable amount of time. Though that sounds like a silly rule, it's a rule nonetheless. Every IOLTA, active or dormant, still needs monthly reconciliations and a review of every client ledger. And if you find funds sitting there for closed matters, check California's unclaimed property laws because those balances might need to be remitted to the state controller after a set period of time. The point is, silence isn't safety. Reconcile every trust account every month, forever. IOLTA compliance is one of those areas where small habits make the biggest difference. When your reconciliations are timely, your transfers are documented, and your client agreements are written clearly, you protect more than just your books. You protect your credibility. Because when your IOLTA is right, your firm's foundation is right. At chiefbookkeepingofficer.com, that's the kind of structure we help law firms build. Bookkeeping that aligns with bar compliance, your CPA standards, and everyday reality. Because peace of mind doesn't come from crossing your fingers, it comes from reconciling every account.